Hi, my name is James Robinson. I manage money for a living, and this is part 4 in my 5-part series on the stock BHP. This section, we're going to be looking at the dividends for the company BHP. When looking at the dividends, we're not simply looking at how much dividends are being paid, but we're trying to ascertain the likelihood those dividends are sustainable and might even increase over time. For dividend investors, obviously the nightmare scenario is that the dividend goes down. There's often red flags that will tell you if that's likely to happen, so we're going to try and research that and see what we can find out. The first thing that I look at when looking at dividends is I look at them over time and I try and ascertain what's happened both in terms of the total amount of dividends the company has paid over time and the dividends per share the company has paid over time. In theory, if a company is buying back stocks and they paid the same amount of dividends over time, the dividends per share will increase. What we'd like to do is find a company that's doing both. They're buying back some shares and they're increasing the amount of money they're putting into dividends each year. That's a stock that is a very interesting dividend play. So you can see here that the dividends for BHP have basically gone up in a straight line since 2002. It's not dramatic, but it's gone up year after year. In 2002, they were paying about $1 billion a year in dividends. Today, they're paying about $8 billion in dividends. So that's a pretty nice increase over 20 years. There's been a couple of peaks and valleys there, but basically the stock has gone up pretty strictly upward and to the right, which is what we like. The dividends per share have gone up slightly faster than the dividend amount paid because they have bought back some stock. They didn't buy back a lot of stock, but they bought some stock. So just looking at this chart, I would say, well, this is a company, at least based on past history, and if nothing but changes, that should be a very strong dividend investment for those of you looking for income. So when looking at dividends, I know most people simply look at what's the yield. Okay, great, I'd like that stock. They maybe do a little fundamental research into what's happened to the dividends over time. We do a little more research than that here at Robinson Stocks. The first thing that, of course, I look at is the yield that you're earning and the growth. But I also look at dividend safety in the context of earnings. So what percentage of the company's earnings are they paying in dividends, and is that sustainable? I look at dividend safety in the context of cash flow. Oftentimes, earnings don't tell the whole story. Cash flow gives you a different perspective. Finally, I look at dividend safety in the context of its current debt load. The idea here is as interest rates go up, the amount of money that a company has to spend on debt service will increase. And as that number increases, the amount of money that the company has left to pay dividends will decrease. And we want to get a sense for how secure is this dividend income stream relative to the debt load. So we look at all 4 of those things when trying to ascertain whether a company's dividends are strong. So the first thing is the yield for this company's dividend is about 12.63%. That is spectacular. Obviously, when you see a dividend that high, you should look at that with a jaundiced eye. Having said that, this company's dividend does seem to be sustainable at that level. Again, that assumes that the commodities these companies produce don't collapse. But assuming they stay reasonably strong, it does seem to be pretty strong. To put it in context, the dividend yield for the S&P 500 is about 2%, so it's 6 times the average income yield for the S&P 500. And one of the things that I look at when I look at a stock with this high a dividend yield is I say to myself, look, would I be happy owning this company if the dividend yield was 6%? Or if we cut it down in half again and it was 3%, I'd still be reasonably happy. I wouldn't pay a premium for the stock, but this company could move backward in its dividend and still be strong relative to a whole plethora of other investments I might have made instead. So again, we look at a dividend yield of 12% with the jaundiced eye and wonder what's too good to be true here. Having said that, the blue line here is dividends per share. In 2014, they were paying $1 in dividends in share. Today, they're paying almost $3 in dividends per share. Spectacular. The red bar is how much that dividend has increased. And that increase was really, really high in 2015. The increases have been smaller each year since then. So I'm going to tell you the dividend has increased at an average of 20% a year for the last 5 years. But when you look at this chart, you see that maybe a dividend increase of 8 or 10% is more sustainable over time. But again, based on how high this dividend yield is now, we could almost don't care if it's flat for several years. But there is evidence that they do continue to raise their dividend year after year for a very long period of time. So the next thing I'd like to do in researching a company's dividends is get a sense for the security of those dividends by contrasting them with the earnings of the company. So what we don't want to be doing is counting on dividends for a company like Altria that pays more than 100% of their earnings in dividends. That's not sustainable. Sooner or later, they have to either raise their earnings or they've been cannibalizing the company so much to pay dividends that they'll have to cut their dividends. And we don't want companies that cut dividends. It's bad because we budgeted that income. It's also bad because when earnings get cut, when dividends get cut, it's a very bad sign of the market and the stock price is almost certain to decline significantly. So in looking at BHP's earnings on this chart, the green bars are the earnings the company's earned and the red bars are the dividends per share. You can see that there's always a little bit of extra earnings, but frankly, not a lot. The current payout ratio for the company is 70%. The average payout ratio for the last 5 years is 85%. Those are both very high when you consider the average payout ratio for the S&P 500 is 30%. So this company doesn't get an A plus in terms of its payout ratio, but let's remember this company's paying a 12% dividend. If the company was paying a 6% dividend, which would still be spectacular and which I'd still be willing to buy this company, then these dividend income streams would be right in line with the market. Having said that, we've also seen that over the last 20 years, they've paid a dividend that's gone up gradually as well as the earnings have gone up. And so they have a sense for how much they need to be reinvesting back in their business and how much how much excess earnings they need. And so because they've been able to sustain these dividends for such a long period of time, I give them a B in terms of this, in this context. It's not an A, obviously, but it's also not a C or D. It's certainly strong enough that I wouldn't dissuade you from buying the stock based on this chart. Just want to take a second to talk about the same thing that everybody talks about with the YouTube channel. I'd love it if you would subscribe. Obviously, everybody's trying to get more subscribers. You may not know this, but until you have 1,000 subscribers, you're not eligible to bring money off YouTube, and so you're doing this stuff for free. So hopefully you might subscribe. Also, if you're following me and you like these videos, you're making money off the stocks picks that I give you, drop me a line, let me know where you're from. I like knowing where all my subscribers are from. Here you can see my current map, and I'd love to add a lot more dots. Finally, if you want other additional information that comes out more often than my videos, follow me on Twitter. My handle is @RobinsonStocks, and I'll give you updates and videos that I think are interesting, other YouTube videos that I think are worth watching. So that's kind of the housekeeping. So we talked about dividends in the context of earnings, and that's easy to figure out. Here's the company's earnings, here's the dividends, you do some quick math and you figure out what that is. There's another way to look at this, and that's dividend safety in the context of cash flow. Cash flow is not the same thing as earnings. You can hide more things in earnings than you can from cash flow. Cash flow is simply how much money came in, how much money went out, what's the differential. So you can see here a chart. The first line from 2016 to 2020 is cash flow from operating activities. That's cash flow from the main business of this company. And you can see that the cash flow has been pretty consistently between 16 and 15 billion, I should say, until 2020 when it's 27 billion. So that's obviously a nice sign. The next thing you see is capital expenditures. You see capital expenditures have been in a pretty consistent line as well, gradually going up, but for the last 3 years, they've been flat at about $6 billion. So that tells me this company has a pretty good sense of what they need for capital expenditures. So when you subtract cash flow from operating activities, when you subtract capital expenditures from cash flow from operating activities, you come up with free cash flow. That's the money the company has at the end of the day that they can use to pay dividends. So you can see the free cash flow, it kind of bounces around a little bit, but when you subtract out the dividends from free cash flow, you see that this company's in much better shape than they were cash flow from earnings. So what that's telling me is this company has their earnings are in some way being modified, and what that probably is depreciation. We know this is a very capital intensive business. We know they need lots of equipment and they need lots of plants. You get to deduct those costs over time from your earnings, and it's a deduction which is not directly related to a physical expense. We see the capital expenditures are predictable and consistent, and so we get a sense that the cash flow, the dividends as a percentage of cash flow for this year was 38%. On average for the last 5 years has been 55%. So those are much stronger numbers, and those are one of the reasons why I gave a better score on the last slide, because cash flow from earnings doesn't tell the whole story. When you look at cash flow, dividends dividends as a percentage of earnings and you look at dividends as a percentage of cash flow, you get two perspectives from the same issue. And as a result, you can sort of blend them together to get a sense of safety. And so again, because I like the dividend safety from cash flow so much, even though I don't love the dividend safety from earnings so much, when you blend them, I think it's a pretty strong argument that the dividends for this company are pretty safe. So the final thing that I look at is dividend safety in the context of debt. What we do here is we presume that debt is going to have an interest cost, and that interest cost is fixed to some degree. If you issue bonds, then it's fixed, but over time you're going to be retiring those bonds or paying back the loan and having to secure new loans or secure new loans for additional growth in the company. And so what we basically say is, if as interest rates increase at the current debt level, how much is that extra interest expense reducing our ability to pay the dividend? Because you could imagine a scenario if a company has a ton of debt and their interest rates go up very significantly, then all of the money they used to have in earnings is now being paid for interest. So we want to get a sense of that. So what I do is I simply say, at 4% interest, 5% interest, 6% interest, and even extreme interest rates of 20%, how much does that cause an additional interest expense, which is translated into a reduction in cash flow? Then I look at the new adjusted cash flow. The dividends I presume would stay the same. And I say free cash flow minus dividends would be what based on those new interest rates. So if you look at it in the most extreme case at 20% interest, the company would be paying an extra $3.5 billion in interest expense, which reduces cash flow by $3.6 billion. That reduces the net new interest adjusted cash flow down to $16 billion. If they paid the same $7.9 billion in dividends that they paid last year, that would leave them free cash flow minus dividends of $9 billion, and which just means that their dividend payout from free cash flow would go all the way up to 46%, but that's still not very high. And that's one of the reasons why I like companies that have very little debt. Because if you don't have very little debt, if interest rates go up dramatically, it doesn't really affect your business's ability to pay dividends, and it doesn't really affect your business's profits very much. Juxtapose that to somebody who has tons of debt, and they may have to discontinue the dividend because they're paying so much money to the bank and to the bondholders. So that again gives me very strong confidence that the dividend for this company is pretty safe. Again, barring some major catastrophe in the price of coal and copper, which are two of the major products, and molybdenum and potash and all the other things this company makes. So long story short, I think the dividends for this company are pretty safe. So again, we looked at the dividend for this company, 12%. It's spectacular. We looked at the growth, the earnings of dividends have been very, very good. North of 10% and on average north of 20%. Even if they went up at 10%, we'd be very, very happy given how large the dividends are. We looked at the dividends in the context of debt service, no problem at all. We looked at it in terms of the context of earnings, no problem at all. And we looked at it in terms of cash flow, no problems at all. So all in all, I think that the dividends for this company are pretty safe. And if you're a dividend investor, this is a company you really should be considering buying.